welcome to my channel. This video is a part of NISM Mutual Funds tutorial. I've already uploaded chapter 1 to 7 of this playlist. So I request you to first go and watch those videos to get a better understanding about this whole NISM Mutual Fund playlist. And this way you would be able to clear your exam with good scores. And you can get the link to NISM playlist and to previous uploaded videos in the description box at the end of this video as well as on the I button. For this one, we will be covering chapter number 8, which is taxation. And do not forget to watch the MCQs at the end of each chapter because that will give you a practical exposure. Also, if you like my video, do hit the like button and do not forget to subscribe to my channel. Now let's start with this one. So starting with the concept of capital gain and dividend income. Investors can earn return from mutual funds in two main forms, dividend income and capital gain. Both dividend and capital gain are taxable to investor. So basically in this whole video, in this whole chapter which is on taxation, we would be learning about the taxation that is levied to the investors as well as the mutual fund companies. And before moving on to that, we first need to understand the concept of capital gain and dividend income. So when you as an investor, you are investing in any mutual fund scheme, you can earn your income in two major forms. Either you will be getting dividend or you will be getting capital appreciation in your scheme or you will be getting both. Okay. So there would be two types of income, dividend income and capital gain. Now let me just explain this both to you, but before that just look at this point that both these income, either we talk about dividend income or we talk about capital gain, both are taxable to the investors. The investor in growth plan would earn capital gain or losses whenever one sells the unit of the scheme. Okay, you must have seen that for any mutual fund scheme, there are two options provided. First will be growth option, second will be dividend option. So maybe you have invested in any of the mutual fund scheme, you must be aware that which plan you have chosen. Is it which option you have chosen? Is it growth option or dividend option? So in growth option, what happens is that, for example, you have invested in a particular scheme. Now that scheme value when you invested, the NAV, it was rupees 10. Now it has appreciated to rupees 12. So the 2 rupees, that is gain. Okay, that we will call as capital gain to your NAV. NAV has increased and that 2 rupees from 10 to 12 is the capital gain. Now what happened that when you decide to sell your units in the scheme, you will be earning 2 rupees extra. Now that would be called as capital gain because there is appreciation in the NAV of the scheme in which you invested. Now other than that, it may happen that you invested at a price of rupees 10 but it went down to rupees 8. So you have incurred a capital loss of rupees 2 again. Okay, so that would be called capital loss. So this is what this line over here is mentioning. What is capital gain and what is capital loss? So if the investor who have invested in growth plan would be earning capital gain whenever one sells the unit of the scheme. If the selling price of scheme is more than purchase price, investor earn capital gain and vice versa. So if your selling price, the price at which you are selling your mutual fund scheme, that would be greater than the price at which you bought your mutual fund scheme. If the selling price is greater than your buying price, your purchase price, or what we say cost price, then you will be earning profit or what we call as capital gain. If your selling price will be lower, your NAV went down and your purchase price was higher, then you will be incurring capital loss. Now, if you will be incurring capital gain, we have already learned that capital gain would be taxable to the investor. Okay. Now let's see, on the other hand, the investor in the dividend plan may get dividend as and when declared by the fund. Okay, so let me just make this one more time clear that when you are investing in growth plan option, whenever the mutual fund companies declare dividend to the investor, that dividend would be reinvested in your scheme. So it won't be provided, it won't be credited to your account directly. That dividend would be reinvested in your scheme, and that is why your scheme's NAV will increase. The net asset value of your scheme will increase. So because you have chosen the growth option. Now, if you have chosen dividend option of your of any mutual fund scheme, so whenever the mutual fund company declares dividend to the investor, you will be provided that it will be credited to your account. So in that case, it won't be added to your scheme again. It won't add your NAV. So your NAV will not increase. Your NAV will be at lower point as compared to the growth option. So generally you will see that when you the same mutual fund scheme, when you choose the dividend option, it would be having a lower NAV, lower net asset value. And if you choose the growth option, it would be having a little higher NAV. So that is the net asset value will be higher in growth option. So dividend option, what happens whenever the company will be declaring dividend, you will be provided with that, as well as any kind of capital gain. So other than that, you are getting capital gain also. If your selling price will be more than your purchase price and you will be selling your mutual fund scheme, you will be getting capital gain. But meanwhile, if any kind of dividend is declared, that also you will be getting as an investor. But the only problem will be the NAV will be lower as compared to growth option, because in growth option the dividend is being reinvested and that is adding value to the NAV. So this is a simple concept of what is capital gain, what is capital loss, what is dividend, and what is growth and dividend plan. Okay. Now let's see. Capital gain can further be classified as short-term capital gain and long-term capital gain with different tax applicable. Okay. So if you are making profit within 1 year, that will be termed as short-term capital gain for you. But if you are making profit after 1 year, that will be termed as long-term capital gain. So we will be learning about this in our next slide and we will see how this happens. And here we are mentioning that different tax will be applicable for short-term capital gain and long-term capital gain. So let's learn in detail about this in our next slide. Let's see over here, capital gain taxation. So here I have mentioned fund type, which is any kind of equity fund or equity oriented fund. When we consider equity or equity oriented mutual fund, we mean that 65%, more than 65% of the investment should be in equity asset class. When we consider debt fund or non-equity, it means more than 65% should be invested in non-equity instruments, in debt instruments. So what do we consider as short-term capital gain? If you have made this capital gain in less than 1 year of your investment, and this is for equity fund. If you have made the short-term gain in less than 1 year, if you have invested in equity funds, so that will be termed as short-term capital gain. Now in this type of capital gain, the tax rate which is applicable, it is 15%. Okay, it is 15%. Now the long-term capital gain will be more than 1 year. So if you are gaining any kind of profit, if you are getting capital gain after 1 year of your investment, if you have continued your investment for more than 1 year, and that is why you will see most of the mutual fund distributors, they recommend you that you need to hold it for a longer period of time, at least for 1 to 3 years. They generally say that you should hold it for 1 year or more than 3 years, because in that case the lesser tax rate will be applicable to you. So just see that the long-term tax rate over here is 10%. Now this is in case of equity instruments. When we talk in case of debt fund or debt mutual fund or non-equity oriented mutual fund, so less than 3 years will be considered as short-term capital gain. So if an investor is making capital gain by selling the mutual fund scheme in less than 3 years of the time, that would be considered as short-term capital gain. And the tax applicable will be 20% after indexation. Indexation means adjusting to the price. Now, long-term capital gain in this case will be more than 3 years. So when we are considering debt fund or non-equity oriented fund, more than 3 years would be considered as long-term capital gain. If any gain is made by the investor by investment in a particular mutual fund scheme by holding it for more than 3 years, that will be considered as long-term capital gain, and the applicable tax rate will be same in this case, that is 20% after indexation. So you will see that for debt fund or non-equity fund, for either short term or long term capital gain is same, it is 20% after indexation. But when we see in case of equity fund or equity oriented instruments, the short term tax rate applicable is 15% and the long term tax rate applicable is 10%. Now let's see exemption of capital gain tax. So there is exemption provided up to rupees 1 lakh. In case of long-term capital gain arising out of equity shares and equity-oriented mutual fund, the tax is applicable only on capital gain above rupees 1 lakh. So you as an investor, if you have invested in equity shares or equity-oriented mutual funds, equity mutual funds, so the tax will be applicable on your capital gain only when you have made a gain that is above rupees 1 lakh. So you have made a profit which is above rupees 1 lakh, then only the tax rate that we just now saw will be applicable. The tax rate of 10% and 15% was there. So it would be applicable only in that case that you have made a profit of profit above rupees 1 lakh. But if you have made profit below rupees 1 lakh, there would be no tax levied on you as an investor if you have invested in equity oriented mutual funds. So let's see this example that, for example, if you are an investor and you have earned a long-term capital gain worth rupees 90,000 in a year. So maybe you have invested in any mutual fund scheme and in one particular year you have earned a profit of rupees 90,000. So this is capital gain, this is profit, rupees 90,000 that you have earned on your investment in mutual fund scheme. So in this case, your entire capital gain, your entire profit, there will be no tax applied on it. There will be no tax levied on it. On the other hand, if the total capital gain is more than 1 lakh rupees, so for example, you as an investor in one particular year, you have earned about 1,10,000 as profit from mutual fund. In that case, for first 1 lakh rupees, there will be no tax levied, but the extra 10,000 rupees will be applicable to the tax, and the same rate which we learnt just in the before slide, the 10% and 15%, the same rate will be applicable, but only after your profit is more than 1 lakh. Okay, so this is exemption provided to the investors in terms of capital gain. Now let's talk about dividend taxation. So we learned about two sources of income for the investors. First in the form of capital gain and second in the form of dividend income. So how taxation is levied on dividend? Now a new regime as per amendments made in budget 2020, dividends offered by any mutual fund to the investor are added to their overall income and taxed at respective income tax slabs. So this may be not given in your NISM PDF, but you must be aware. That's why I have included this in particular slide. In the budget 2020, this amendment, these changes has been made. Now you as an investor, if you are earning any kind of dividend income, your dividend income will also be applicable to the taxes. And this will be according to your respective income tax slabs. So there is different income tax slabs made as defined by your income category. So the same tax slab will be applicable even to your dividend income. Now you know that when the income tax is charged, it is on various incomes. Income for an individual. It can be your income from property, it can be your income from business, your salary income, as well as your this type of capital gain, and now dividend is also included in this. Before, dividend income was not included. So as per this changes made in budget 2020, you as an investor, you will also be charged on your dividend income as per your respective income tax slab. Let's see this previous regime. In this previous one has been mentioned in your NISM mutual fund PDF. So previously what happened, dividend was were made tax free to the investors up to rupees 10 lakh. So till 10 lakh, if there was any kind of dividend income to the investor, there was no taxes charged on that. However, the mutual fund companies, they were liable, sorry, however, the mutual fund companies, they were liable to pay DDT, that is dividend distribution tax, before sharing profits with investor in form of dividend. So the mutual fund companies were required to pay this DDT, dividend distribution tax, before distributing the dividend to the investors. And for the investors up to 10 lakh, there was no taxes charged. So just go through this line. During this, dividend of up to 10 lakh a year were made tax free to investors. Any dividend in excess of 10 lakh attracted dividend tax at 10% for equity schemes and 25 to 30% for non-equity oriented schemes. So this value you can remember that previously if any dividend income was above rupees 10 lakh for the investor, the tax applicable was 10% in case of equity fund and 25 to 30% in case of non-equity mutual fund. Now let's come to securities transaction tax, and this tax is charged on the basis of transactions being made in terms of purchase and sell. So when investors sell units of an equity fund in the stock exchange or make redemption to the fund, they will have to incur securities transaction tax. So when you as an investor, you have invested in equity fund and you are selling your fund in stock exchange. Today stock exchanges are also facilitating mutual funds transactions. So if you are selling your units in stock exchange or either you are making redemption means you are selling your mutual fund units and you are getting back your money. So when you are making redemption is also referred as repurchase, sell, redemption, all its same terms used for mutual fund selling of units. So in case of any redemption or repurchase also, securities transaction tax is charged. FCT is applicable only on redemption switch to other schemes or equity oriented mutual funds. Okay, so this is only charged when you are selling your mutual fund units, or you can say when you are redeeming your money. Also, when you are switching from one scheme to another scheme, it won't be applicable in any purchase being made by the investor. So if you are buying mutual fund units, this charge won't be applicable. But if you are selling, if you are making switch transactions, it would be applicable on that. STT is not applicable on purchase of units of an equity scheme. It is also not applicable to transaction in debt securities or debt mutual funds. Okay, so just remember this, that STT, securities transaction tax, is not applicable on debt mutual funds, on debt instruments. It is only applicable on equity schemes, and that too it is not applicable on purchase of equity schemes. It would be only applicable if you are selling, if you are making switch transactions, or if you are redeeming your money. Securities transaction tax of 0.001% is levied by government to investors who sell their units of an equity mutual fund or equity oriented hybrid fund. So on selling of your mutual fund units, you will be levied with this tax, which is 0.001%, and this taxation is charged by the government in terms of securities transaction tax. Now let's come to TDS, tax deducted at source. So according to new regime, that is in the recent budget of 2020, DDT is abolished. DDT means dividend distribution tax. This has been abolished, and only AMC is required to deduct TDS at 10% on distribution of dividend, provided that the dividend paid per investor exceeds rupees 5,000 in a year. So AMC or mutual fund companies which were previously having that responsibility to pay dividend distribution tax, now that has been abolished for them. Rather than that, now they are paying this TDS, that is tax deducted at source, at 10%, and that is only when the dividend provided to one single investor is more than rupees 5,000 in one particular year. Previously, what happened, there was no such TDS charged on dividend distribution or redemption proceeds to resident investor. There was only DDT charge, that is dividend distribution tax was charged on companies distributing dividends. But this change has been made recently in the budget, and now this DDT is abolished. Now TDS is being charged at 10%. Now let's talk about GST. This was also a major change, goods and services tax. GST became applicable since year 2017, and AMCs can charge GST as per applicable taxation law to the scheme limits within the limits prescribed under SEBI mutual fund regulation. So as soon as GST was introduced, it was also applicable in the taxation laws, and that was regulated under SEBI mutual fund regulations. So let's see. GST on fees paid as investment management and advisory fees. So we have learned this in previous chapter, where we learned about this total expense ratio, that how investment and advisory fees is also being charged, brokerage and transaction cost is also being paid. So GST is being charged on fees paid as investment management and advisory fee, also on brokerage and transaction cost. And whatever GST is being charged on these transaction cost or advisory fee, that need to be adjusted into total expense ratio. So total expense ratio is what is charged to the investor, and there is a limit set, which we learned in previous chapter. There was a limit set with more than that which cannot be charged to the investor. So within that limit, this shall be adjusted. The GST shall be adjusted. The commission payable to the distributor of mutual fund may be subject to GST. So mutual fund distributors are also, their major source of income is the commission that they get by distributing the mutual fund units, and in this case such tax cannot be charged to the scheme. The commission payable to the distributors of mutual funds may be subject to GST. Such tax cannot be charged to the scheme. So the commission that is payable to the distributors of mutual fund, they are also paying this GST charges. They are also being charged with this GST. But this commission that is being paid to mutual fund distributors, that is not included in the scheme. So that is not being levied to the investor. However, just now here we saw that total expense ratio that is levied to the investor, that is being the GST is being managed over here, the investment management and advisory fee, brokerage and transaction cost. However, when we talk about commission that is paid to mutual fund distributors, that is not charged on the scheme, so that is not adjusted in TER, that is separate. GST on exit load, if any, shall be deducted from exit load, and net amount shall be credited to the scheme. So GST on exit load. Exit load, we learnt about this also. What is exit load? So certain mutual fund schemes come with a definite period of investment, which as an investor you should hold on. If you are redeeming your money before that investment period, you would be charged with that exit load. So GST on exit load shall be deducted from exit load, and the net amount shall be credited to the scheme. So exit load is also charged with GST, and it is deducted from the same exit load only. Now tax benefit under 80C to investor. What is the tax benefit that investor can get under 80C of Income Tax Act? So there is one scheme called equity linked savings scheme. This is a kind of tax saving fund. Now these schemes, equity linked savings schemes, are eligible for deduction under section 80C of Income Tax Act. Now what is the benefit that you can avail as a the benefit is available up to rupees 1.50 lakh per year per taxpayer. So whatever income tax you are paying, if you want to make deductions from that, if you want to reduce your income tax payable, you can just, and if you have invested in this equity linked savings scheme, you can mention this under sections 80C of Income Tax Act, and you can get the benefit of maximum up to 1.50 lakh per year. So this could be your saving if you have invested in this particular mutual fund scheme, in the ELSS scheme, because this is included in Section 80C of Income Tax Act. So you can get this benefit. The scheme has a lock-in period of 3 years from date of investment. It is also an equity-oriented scheme, so it comes with a lock-in period of 3 years. Now let's see some more concept of setting off and dividend and bonus stripping. So long-term capital loss can be set off only against long-term capital gain as provided in Income Tax Act. So as we read that capital gains are taxable when you exceed a certain amount. So in that case, investors, they try to manage, they try to reduce their tax, they try to save their tax or get exempted from tax anyhow. So one such way that is allowed is that if you have incurred any capital loss, because we talked about capital gain, there can also be capital loss in any of the scheme you have invested. So if you have incurred any long-term capital loss, you can set off it against your capital gain, and in that way you won't be charged any tax under Income Tax Act. So this is one way, okay? So capital loss can be set off against long-term capital gain as provided in Income Tax Act. If there is any kind of short-term capital losses, that can also be used to set off your long-term and short-term profits that will be chargeable, that will be taxable under Income Tax Act. So for example, you have incurred a good capital gain in long term and short term by investment in mutual fund schemes, and now you know that you will be taxable with Income Tax Act. So you can just show your any kind of short term capital losses, and that will be used to set off your taxes applied on it. Dividend stripping is the practice of buying a share or mutual fund unit just before the declaration of dividend and then selling it off right after the receipt of dividend when share prices fall below purchase price to evade taxes. So dividend stripping is another way of evading tax or trying to save yourself from taxation on the gains and the profits. So how this is done, investor, when they have an idea that the company is going to declare dividend right now, so what they do, they invest either in mutual fund or the share. The same concept applies to both. So they invest in the share or mutual fund, they buy the units just before the declaration of dividend, and they receive the dividend whatever is declared, they just get that, and as soon as they get the dividend, they sell off their share, they sell off their mutual fund units. Because what happens generally when the dividend is declared in terms of share or mutual fund units, the share prices tend to fall. As I said, that you will see that the dividend option in mutual fund, they have generally lower NAV as compared to growth option. So as soon as dividend is declared, the share prices, the mutual fund prices, they tend to fall. So what happened? The investor, they try to get an idea that when the dividend is going to declare, and soon before the declaration of dividend, they buy the units, they invest in that, and once they get the dividend, they sell off the units. In this case, what happens that they have earned an dividend income, and also they will show that the share prices have fallen, which means capital loss. Now capital loss means there will be no taxation charged on you. Now this capital loss can also be used to set off your capital gains taxation. So you are having, we can say, two profits at one time. So one, you are using your capital loss for setting off your taxes on capital gain, and another way you are also getting this extra dividend income by holding for shorter period of time. So this is generally a practice that is being obtained by the investors to evade any kind of taxes on their mutual funds or shares. Same concept applies to bonus also. So in bonus stripping, investors acquire units just before the company makes any bonus issue. Once they issue bonus units to the investors sell the original units which they had earlier. This lead to short-term capital loss, and this short-term capital loss they can use to adjust their capital gains, the taxation on capital gains. Later, after 1 year bonus unit, they dispose. So they are getting bonus also, and they are using the short-term capital loss to avoid taxes on capital gains. So this dividend stripping and bonus stripping is two of the strategy being used by the investors to evade any kind of taxes on their share or mutual fund units. Now it's time to MCQ, so just try to attempt all the multiple choice question to get an idea whether you are clear with the concepts or not. Question 1. Redemption from which of the following mutual fund scheme would attract securities transaction tax for an investor? A. Government securities fund, B. Multi-cap fund, C. Liquid fund, D. Overnight fund. So the correct option is B. Multi-cap fund. We learned that STT or securities transaction tax is applicable only to equity or equity oriented funds, not to debt funds. So rest of the three, government securities, liquid or overnight, these three are debt funds. Multi-cap mutual fund is an equity oriented mutual fund. So this is the correct option. Question 2. In the non-equity oriented funds, the rate of long-term capital gain tax is dash. A. 20% with indexation, B. 10% with indexation, 20% without indexation, 10% without indexation. And the correct option is option A. 20% with indexation. Question 3. The Income Tax Act allowed setting off of the short-term capital loss against long-term capital gains. State whether true or false. Option A true, option B false. So the correct option is option A true. Question 4. Equity-linked savings scheme are eligible for deduction under Section 80C of Income Tax Act up to an amount of dash. A. Rupees 2,50,000, B. Rupees 2 lakh, C. Rupees 1.5 lakh, D. Rupees 1 lakh. And the correct option is option C, 1,50,000. Question 5. In case of long-term capital gain arising out of equity shares and equity-oriented mutual funds, the tax is applicable only on capital gain above rupees 1 lakh. State whether this is true or false. Option A true, option B false. And the correct option is option A true. So thank you for watching. Thanks a lot. Keep up the support.